People often ask me, I've heard of swaps, but what exactly are they? People usually expect a simple one sentence answer. But the truth is, a swap isn't just one product. It's an entire family of instruments that show up everywhere in modern finance. At its core, a swap is just two parties agreeing to exchange cash flows. But that simple idea branches into dozens of structures across a range of different asset classes: interest rates, FX, credit, equities, commodities, and many more. Welcome back to Derivatives and Risk Education. In this series, we're going to explore the world of swaps, one instrument at a time. We'll build intuition first, then look at mechanics, and then we'll look at real world use cases. And later in the series, we'll also look at how these swaps are valued. Before we dive into the details in later videos, in this one, I want to give you a guided tour of the swap universe by looking at 10 of the most important types of swaps. Each one gets a quick explanation, a real world use case, and a simple pay and receive example. Number 1, the fixed floating interest rate swap. This is the foundational swap in global markets. A company with floating rate debt might want certainty, so they swap into fixed. Or a bank with fixed rate assets might want floating exposure. The key is that the swap lets them change the interest rate profile without touching the underlying loan or bond. So, for example, party A pays 3% fixed and receives 3 months SOFR. Number 2, a basis swap, single currency. Basis swap exchanges one floating rate for another floating rate. A bank might fund itself at 3 months SOFR, but hold assets linked to 6 months SOFR. To eliminate the mismatch, they swap 3 months for 6 months. This aligns their funding with their assets and removes tenor risk. So, for example, party A receives 3 months SOFR and pays 6 months SOFR plus 2 basis points. Number 3, cross currency swap. A borrower might issue fixed rate dollar debt because it's cheaper, but their revenues are in euros. To eliminate FX risk, they enter a cross currency swap. At the start, they exchange notionals, deliver US dollars, and receive euros. Throughout the life of the swap, they pay euro interest and receive dollar interest. And at maturity, they re exchange the notionals, neutralizing principal FX risk. An example: party A pays Euribor and receives 5% fixed in dollars, with euro and dollar notional exchanges at the start and at maturity. Number 4, an asset swap. Say an investor owns a fixed rate bond, but prefers floating rate exposure. In an asset swap, they pay the fixed bond coupon and receive a floating rate, typically SOFR plus a spread. This synthetically converts their fixed rate bond into a floating rate bond. They keep the credit exposure, but remove the interest rate exposure. For example, investor pays the bond's 5% coupon and receives SOFR plus 120 basis points. Number 5, credit default swap, CDS. A lender holding a corporate bond wants protection against default, so they buy a CDS. They pay a periodic premium and receive compensation if the company defaults. This isolates credit risk from interest rate risk. CDS spreads are widely used as a measure of credit worthiness. It's the core building block of the credit derivatives market. So, as an example, the investor pays 100 basis points per year and receives default protection on company X. And number 6, total return swap. A hedge fund wants exposure to an index but doesn't want to hold it on the balance sheet. So they enter TRS. They receive the total return of the index and pay a floating rate. This gives them synthetic exposure with leverage and no custody. Banks use TRS to provide financing efficiently. The clean separation of economic exposure from ownership. So, as an example, party A pays SOFR plus 50 basis points and receives the total return of the S&P 500. Number 7, a commodity swap. An airline wants to lock in future jet fuel prices. So they enter a commodity swap. They pay a fixed price and receive the floating market price. This stabilizes their fuel costs and removes price uncertainty. So producers and consumers use these swaps to hedge production and consumption risk. And banks intermediate between the two sides. As an example, an airline pays fixed $80 per barrel and receives the floating oil price. Number 8. OIS swap. OIS swap exchanges a fixed rate for a daily compounded overnight rate. Banks use OIS swaps to hedge short-term interest rate risk. These swaps also form the backbone of modern discounting frameworks. An example, party A pays 2.5% fixed and receives compounded SOFR. Number 9. Range accrual swap. A yield-seeking investor wants higher income and believes rates will stay stable. So they enter a range accrual. They receive a high coupon, but only if the reference rate stays within a band. If rate moves outside the range, the accrual stops. This embeds optionality. Banks package these into structured notes. As an example, party A receives 5%, but only if SOFR stays between 2% and 4%. Number 10. PRDC swap. PRDCs are long-dated, highly structured cross-currency products sold mainly to Japanese investors. The investor buys a PRDC note, and the issuer hedges the exotic coupon by entering a PRDC swap with a dealer. In that hedge swap, the issuer receives the note's coupon, so they can pass it on to the investor and pay floating in their funding currency. The structure embeds long-dated FX and interest rate volatility. As an example, the issuer receives the PRDC note coupon and pays floating in their funding currency. The investor only sees the note. In the next video, we'll look in more detail the most common swap, the single currency fixed floating interest rate swap. After that, we will look at many of the other swaps mentioned today. Found this video helpful? Don't forget to like and subscribe so you don't miss any video in this series. Thanks for watching.